Can I actually grow my Canadian real estate portfolio using only smart tax tips? As a real estate investor in Canada, you're likely always on the lookout for ways to maximize your returns. And one often overlooked way to do just that is by leveraging smart tax strategies. In this video, we're going to dive into some actionable tips that can help you keep more of your hard-earned money. Many investors overlook tax planning, and that's a huge mistake. Think about it, without a solid understanding of how to navigate the tax implications of your investments, you could be leaving thousands of dollars on the table. Canadian tax laws can be complex, especially when it comes to real estate. You've got to consider everything from capital gains to rental income, and if you're not careful, you could end up owing more than you anticipated. The problem is that a lot of investors just don't take the time to understand the tax side of things. They might be great at finding deals or managing properties, but when it comes to taxes, they're flying blind. And that's a recipe for disaster. Understanding your tax obligations is crucial. You see, when you sell a property, you're going to be on the hook for capital gains tax. But did you know that you might be able to avoid paying that tax altogether if you're savvy about it? One key concept to grasp is the principal residence exemption. If you're buying, selling, or already own a property that you've lived in as your primary residence, you might be eligible to not pay any capital gains tax at all. That's a huge potential savings right there. Another thing to consider is what expenses you can write off. When you're earning rental income, you can deduct a lot of the costs associated with maintaining that property. Think about things like repairs, property management fees, and even some travel expenses if you're managing your properties. Allowable expenses can really add up. For example, if you've got a property that's generating $2,000 a month in rental income, you might be able to write off $500 or $1,000 of that in expenses, which can significantly reduce your taxable income. Now, understanding the difference between capital gains and income is also vital. If you're selling a property, you're going to be dealing with capital gains tax. But if you're earning rental income, that's considered income and taxed differently. Getting this right can save you a lot of headaches. And let's not forget about the benefits of professional tax advice. Working with a tax professional who understands real estate can be a game changer. They can help you navigate the complexities of the tax code and ensure you're taking advantage of every deduction you're eligible for. One common, costly mistake investors make is not keeping accurate records. If you're not tracking your expenses and income meticulously, you're going to have a much harder time when it's time to do your taxes. And that's when you might end up owing more than you anticipated. Another strategy that's often overlooked is the benefits of incorporating as a real estate investor. Depending on your situation, incorporating might help you save on taxes, especially if you're earning a significant amount of income from your properties. To maximize your Canadian real estate investment profits, you've got to have a solid grasp on these tax strategies. We're talking about understanding principal residence exemption, allowable expenses, and the difference between capital gains and income. These are not just minor details, they can significantly impact your bottom line. Thanks for watching, and I hope you found these tips helpful. If you're serious about growing your Canadian real estate portfolio, be sure to subscribe for more real estate investment tips. Got questions about taxes and real estate investing? Leave them in the comments below. And if you're looking for more strategies on how to manage your properties effectively, be sure to check out our other video on property management strategies.